If you find this video helpful, please don't forget to like, share, and subscribe. Now let's turn our attention to the other side of the coin, the reverse stock split. As its name suggests, this is the exact opposite of a forward split. Instead of increasing the number of shares to lower the price, a reverse split decreases the number of outstanding shares to artificially inflate the price of each share. This is a far less common maneuver and, critically, it is almost always perceived as a negative signal. Companies that perform reverse splits are typically not doing so from a position of strength. Instead, they are often struggling, and the reverse split is a defensive measure taken to solve a serious problem, usually related to their stock exchange listing. The mechanics are an inversion of a forward split. A company might announce a 1-for-10 reverse stock split. In this scenario, for every 10 shares you currently own, you will receive just one new share. If you held 1,000 shares of this company, your holding would be consolidated down to just 100 shares after the split. To keep the total value the same, the price per share is multiplied by the same factor. If the stock was trading at a dismal 50 cents per share before the split, the new share price would become $5 10 times 50 cents. Your total investment value remains unchanged, but the structure of your holding is dramatically different. So why would a company do this? The most common reason is to avoid being delisted from a major stock exchange like the NASDAQ or the New York Stock Exchange. These exchanges have minimum share price requirements, often mandating that a stock must trade above $1 per share to remain listed. If a company's stock price falls into penny stock territory and stays there for too long, it risks being kicked off the exchange. A reverse split is a last-ditch effort to artificially boost the price back above the required threshold and maintain its listing, which is crucial for liquidity and investor trust. For an investor, a reverse stock split announcement is typically a major red flag. It is a clear admission from the company that its business is struggling so much that its share price has collapsed. While the split itself fixes the immediate price problem, it does nothing to address the underlying fundamental issues: declining revenue, mounting losses, or a failing business model that caused the price to fall in the first place. Therefore, unlike the optimistic signal of a forward split, a reverse split is often seen as a signal of distress and desperation, a corporate action taken not for growth, but for survival.